Interest rates are down, but will this continue, and how much will it continue is what we'll be digging into today. So interest rates have come down just slightly over the course of the past 7 days. Let's dig into the data as to why. So first, last week we had PCE, which is basically the Fed's preferred measure of inflation. It came in right at expectations, and what we were looking for, or what the Fed was looking for, is added inflation, and that's not what they got. It came in a little hot, but nothing too crazy to really frighten them. And then this week is labor market, and we had a meeting and a conference with Jerome Powell. Today, Jerome Powell reiterated that the last rate hike is likely in, and they do plan on cutting rates this year. The question this year, when, right? Is it summer? Is it Q3, Q4? That is what is still to be determined, and it's going to be all determined on inflation and labor. So we know inflation still hovering around that 3% range. Want to push more towards 2%. Once we start getting closer to 2, you can fully expect rate cuts. And then the other second wild card is labor. And this week is labor data week. So today we had JOLTS and we had the ADP unemployment survey come out. JOLTS basically is a measure of job openings. And it came in right at expectations, around 8.8, 8.9 million. And remember, you look at the peak in COVID, or the peak about a year and a half ago, the job openings were over 12 to 13 million. So we've come down over 5 million, 4 to 5 million in job openings in just the past few years. Trend from the past 2-year perspective is down. Trend from the past 12-year perspective is up. So we're at that boiling point of, will job openings continue to come down, because then that 10 to 12-year trend will no longer be up. So it's a key point to watch. And then ADP kind of came in lower expectations, not showing as many job openings. The key other labor market reports that we're looking at is tomorrow, jobless claims. Last week showed more jobless claims, more people requesting insurance for losing their job, which is huge, and it's one that comes out every single week I'm watching. And then Friday, the very, very big number, non-farm payroll. The unemployment rate is what we're going to be watching. So big data still to come out to see if the interest rate fall is going to continue, or if this was a blip, or even vice versa, even go up. And then another data point that we saw, which could trigger interest rates to go down a little bit, is GDP. So GDP usually ranges between 3 to 4.5 to 5% on a quarter-over-quarter basis, basically increasing 3% per quarter. It was projected 3%, but just last week it fell all the way down to 2%, which still shows that the economy's fine. Remember, in order to have a recession, you have to have negative GDP back-to-back quarters. But we fell from 3% to 2%, which does show that the economy is in fact slowing from every single quarter that we saw last year. So will this trend continue? We're about 70% of the way through Q1. Still have all March to go, but the trend is lower. Will the trend continue to remain lower? Because if GDP slows, that means the economy is slowing, which could then fuel the Fed's ammunition to have that rate cut sooner. Right now, rate cut is projected for June, and we're expected to see around 4 rate cuts this year. Nothing too drastic. Again, we've seen it kind of continue to shift back month in and month out. 9 months ago, the first rate cut was projected in October of last year, December. Then it got pushed back to Q1. Then the first rate cut got pushed back in. So now we're about Q2. Everyone was expecting March 20th to be that first rate cut. Not happening, looking more like June. So the more the data comes out, the more it will add and give ammunition to the Fed to then have these rate cuts. But we need more data like what we're seeing. And that is slower job growth, that is a slower inflation, that is slower GDP growth, which is what we've seen, a far twist from what we saw in January. Remember, January, everything came out bullish, which is why interest rates spiked 0.5%, even 0.75% in just January. This month, major difference here in February and the beginning of March. Everything seems to be slowing. So now again, March, what will happen? We'll have to wait and see. But overall, good signs, good trend for the mortgage industry. Lower rates will lead to more affordable housing and overall a much healthier housing economy.